Hi, and welcome back to Hedge Fund Manager. I'm Karl-Mikael and today I'm doing a deep dive into Novo Nordisk. Let's now check the macro picture. Remember again, what do we mean by the macro picture? There are maybe two important questions to ask oneself. That has to do with the economy in general, and the second one has to do with the average or overall valuation levels for the entire market. And we can break this down into a couple of questions. So for example, is the economy strong or weak? And what do we mean by that? What we mean by strong or weak is things like, is the unemployment high or low? Are interest rates high or low? Is GDP growth high or low? Has it been recently? How about sentiment indicators? Indicators like the ISM and the PMI. What these measure are purchasing managers' plans for their companies. Are they going to hire more or less this month than the next? Are they going to what do they think about the level of demand or their size of their order books, etc. And pricing, not least. They ask them about pricing. Is it easier or harder to raise prices? So these are the things that we ask in the macro section. Is the economy strong or weak? And what we really are after is, will it be easier or harder for the company that we are researching to reach its forecasts, actually to reach your forecasts for the company, because that is what creates the downside or upside risk to your total assessment of the company. And we're not least trying to estimate, is the economy on its way up or on its way down? So for example, if the economy is really weak with high unemployment and weak ISM and PMI readings, etc., then it actually might be on its way up. And especially if it has already started to improve a little bit. So actually having a really weak economy, but that is a little less weaker than it was about a month ago or so, that could be the most positive macro setup you can imagine, because that means that the economic cycle has started turning the spiral upward, and it has a long way to go to close the production gap. So a weak economy that has started to improve, that's actually much better than a strong economy, usually, because a strong economy has inherently the risk of becoming weaker, and it's already very well known that the economy is already strong. So this is a typical example of coincidence of opposites, or that you have to kind of take the inverse perspective of whatever you're seeing. So again, a really strong economy is not necessarily positive for your case. And next, and the next macro question we ask ourselves is the stock market cheap or expensive? And again, this has we have to think the same way here that as we did with the strength of the economy. Does a high market valuation, does that mean that all stocks could or should have higher multiples than usual? So for example, if the market is valued at 20 rather than 15 times, does that mean that your company, if it was average, that it's more likely to be valued at 20 times rather than the warranted 15 times? And the question is, should we take that into account? Also, does a high market valuation, for example, if the market is valued at, right now, the Schiller PE, for example, it's at about 35 times rather than 15 times. Maybe that means that the entire market valuation is at risk of falling back, of reverting to its own mean. And that could pull down all stocks, including our stock. These questions do not have ready-made answers. You can't say beforehand which is which, but you have to just take both into consideration. And it depends on both the level and the most recent trend. Like if it's a low valuation that has started to trend upward, that is probably very positive for your stock as well. All right, so let's take a look at the current picture. Well, the market it's very expensive. I would say that it will act as a magnet for all stocks. You should expect stocks to be a little higher valued at least than they usually are. However, the warranted level 4 years out, that should still only be what is absolutely fundamentally warranted. Perhaps slightly higher because we are probably in a pretty long-term era of higher than average valuation, that is higher than what they've been the last century. So what about the macroeconomy? Well, a recession seemed to be inevitable due to the tariffs not least, and also it's been a long time coming. After that we will probably get huge stimulus efforts again, but probably with a lag due to the inflation scare that we went through in 2022. So central bankers do not want to overstimulate too early, but they will probably sooner or later, just with a lag. So this is also negative. We also have pretty high interest rates and pretty strict lending standards, and this is negative, not least for mortgages and for consumption. So it's in general negative for the economy. So the economy is actually pretty strong but heading downward. So that is kind of a big headwind. So a negative for the probability of our stock reaching its forecasts, reaching our forecasts for that stock. We could take into consideration as well things like fourth turning style developments. The geopolitical turmoil, it's at a high level recently. We see President Trump going head on against other world leaders. But perhaps we could see these things recede a little bit. They could improve. So they are at a kind of an extreme, a crescendo perhaps right now. But if they were to recede, then that would be an added positive for the market. So again, you have to always be aware of the inverse of the first level thinking. And other things to try to assess is whether consumers, are they shopping and traveling, or are they being more tight-fisted in their behavior? Are they saving more? Are they maybe shopping more at Walmart than at more luxury brands? Are they shopping more for small items rather than capital goods, etc.? There are a lot of things that could be taken into consideration here. Ray Dalio's huge debt cycles and empire cycles, for example, or Hussman's valuation cycles, or his compound measurements and gauges of where the economy is going. These are definitely important and interesting things to look at. But in general, remember, you do not want to be a macro tourist, to think that you understand these things after just looking at a couple of data series, macro data series. This is difficult material, and I also think that it's unnecessary usually. It's only helpful to consider macro factors when they are at an extreme high or an extreme low, and could be probably guessed to start to mean revert towards some kind of a more midpoint more normal level, and that could be a slight headwind or tailwind, making it easier or harder for your company to attain the forecasts you have already put to it. So apart from that, you shouldn't really consider these macro factors. The same goes for both the economic cycle and the valuation cycle. It doesn't really matter that Schiller PE or Hussman MAPE are super expensive. It's not really helpful to hope for these valuation multiples to shrink to some kind of a normalized level. It's more important to just consider exactly what your company is doing.